Have you ever seen the words preferred equity or common equity in a deal memo and just skipped over them, hoping that they weren't that important? In today's episode, the Passive Income Playbook on the Best Ever CRE show, we're breaking down one of the most misunderstood parts of passive investing, the capital stack. Specifically, we're going to explain what preferred equity actually is, how it compares to common equity, and what that means for your returns and your risk as an LP investor. I'm your host, Pascal Wagner, and joining me today is Paul Moore, founder of Wellings Capital, a fund of funds manager that's raised over $190 million from nearly 1,000 investors across at least 6 funds in self-storage, multifamily, mobile home parks, and more. Over the past 5 years, Paul's firm has shifted its strategy away from common equity and more towards preferred equity. And in this episode, you'll learn why that shift matters, how it protects LPs, and whether it's the right approach for your own investing. And with that, let's dive in. Welcome, Paul.
Hey, great to be here, Pascal. How you doing?
I'm doing great. I'm excited to dive in here. So,
all right.
As I mentioned, I want to really dig into the capital stack, preferred equity, common equity, understanding the whole landscape. But I think in order for everyone to have a better understanding of who you are and how you got here, I would love for you to share a little bit of your story that you think is relevant to what got you into doing Wellings Capital.
All right. Well, let's see. I worked at Ford Motor Company, and I had an entrepreneurial itch the whole time. And so I eventually left Ford with a partner. We started a staffing firm, and everything just went so well. It was amazing and unusual. And in about 5 years, we sold to a publicly traded firm. And I thought I was a full-time investor now. I started a nonprofit. I moved to the Blue Ridge Mountains of Virginia. Pascal, I massively failed as an investor. In fact, I wasn't even an investor. I was a speculator. Investing is when your principal is generally protected and you've got a chance to make a return. Speculating is when your principal is completely unsafe and untethered and you've got a chance to make a return. And so I think the problem for me is I was bored. I was knowledgeable about real investing. And I really thought I should get the same charge, the same excitement out of investing that I did out of being an entrepreneur. And so I chased shiny objects. My default was to say yes, which, by the way, for your LP, for your listeners, that's a huge problem because everything looks good at the outset. Every brochure and website, every deal looks beautiful. We looked at 745 deals last year at our company and only invested in 5, but all 745 looked really good. And so for a 34-year-old with a few $1 million, it was a big trap for me. So I ended up making tons of mistakes. I made money on some deals, lost money on a lot of deals, ended up getting into real estate, flipped 50 or 60 houses, some waterfront lots at Smith Mountain Lake in Virginia, and eventually made my way into commercial real estate after yet another failed speculative venture in oil and gas in North Dakota. We invested in oil and gas, failed, but realized, hey, there's like 12,000 people in this little town in North Dakota for the oil boom. There's only 3,000 residents and virtually no housing. Tons of people sleeping in their pickup trucks or their semis. And so we created a housing project in 2011, and that's how I got into commercial real estate 14 years ago. And so the rest is, we could go over the rest if you want, but that's a start. I'll take a breath.
Yeah. Okay. So you basically did all of the, when you made these investments, like you were talking about, like in oil and gas, were they active investments? Were they your first passive investments? What was the, help me understand maybe the breakdown of what was active and passive?
There was some of each. I mean, the real estate, like flipping houses and flipping waterfront lots, was almost all successful, thankfully. I mean, 2008 threw a wrench in it, but even then we did pretty well. But a lot of the the speculations were were passive. I mean, hearing about the guy in Charlotte who had a 2 to 3% monthly return from some exogenous strategy that he couldn't or wouldn't explain. And, I didn't know about Buffett. I didn't know about Charlie Munger. I wish I had, because, Charlie, there's so many good quotes from them about this kind of topic. They say, we don't want to jump over 8-foot hurdles. We want to step over 1-foot hurdles. If it's too complicated, we just pass immediately. And, but that didn't sound exciting to me. I wanted excitement from my investments. Paul Samuelson, the first U.S. economist to win the Nobel Peace Prize, said, investing should be boring. It should be like watching paint dry or watching grass grow. He said, if you want excitement, take $800 and go to Las Vegas.
Oh man, I think I'd love it for it to be that so much more true like that. I think you need to get burned for you to feel that way first, I think is how it goes for most people.
Absolutely. That's why I had a podcast for 4 years called How to Lose Money.
You've now gotten to the point where you've raised almost, maybe it is at this point, but $200 million and have nearly 1,000 investors. Rewind us back to the early days. What were some of the first deals like?
So Wellings Capital, we started again after this North Dakota thing. We were printing money. We sold at the top of the oil boom. It was great. I decided to be a multifamily syndicator and did some mentoring with someone kind of similar to Joe Fairless. And it went really, really well. I learned a lot in this year program, and we launched out. I started by writing a book. It was humbly titled The Perfect Investment, about multifamily investing. And, I was in my early 50s. I know I don't look it, right? But yeah, the guy looks about 80. But anyway, seriously, I was in my early 50s and I was becoming more and more risk averse. I was learning about Warren Buffett and all this. And I realized, hey, these we're competing with people who have been through these mentoring programs, no offense to anybody, and they're overpaying. They've never lived through the 2008 or 2001 downturns. And they're overpaying for assets by about 30%. And they're using risky floating rate debt. And they're believing that trees grow to the sky. In other words, that rents will continue to go up 11% a year in Tucson every year. And we just didn't believe this. So I actually reversed course. I went on dozens and dozens of podcasts. I have my own show on Bigger Pockets on their Instagram and Facebook Live. And I was like, time out. The perfect investment's not perfect. It's not perfect if you have to believe all these lies that, you can take these risks and continue to play musical chairs. Somebody's going to lose. And I thought it was going to happen in 2018. In fact, I began to predict that it's about to collapse. And of course, we all remember December 23rd, 2017, when President Trump, the first one, signed the bill that allowed for a 100% bonus depreciation. And what happened, right the month or two before that, multifamily was softening significantly, and then it took off again. And of course, we all know that it began to falter in March of 2022 with interest rate hikes. But our company, I'm finally going to answer your question. Maybe
I like it.
I'll think about answering your question. We finally, in 2018, we pulled back and said, we're not going to be a multifamily syndicator. We can't compete with these guys who are overpaying by 30% using floating rate debt. And so we had a theory that if we could find, we really wanted deep due diligence. We wanted expertise in an asset class, but we also wanted diversification. It was sort of similar to the Buffett Berkshire model, where he wants deep focus on one asset, but he, as an investor, wants a whole bunch of different ones. And so we began to look at mobile home parks, self-storage, of course, multifamily, RV parks, commercial retail strip centers, and light industrial. And we began to try to find the very best operators we could in each of these. Finally, to your question, so our earliest investments, honestly, it was just my partner, Ben, and I, and we did not have the bandwidth to do the type of due diligence, nor the knowledge. And I no offense to your listeners, but I would say if you're a highly paid medical professional, IT professional, whatever you're doing, you might not have the bandwidth and the knowledge and the resources and the time to deeply, deeply look at these operators and deals. And I'll be honest, in 2018, when we started, we didn't. We made our most mediocre, I won't say failed, but most mediocre investments in 2018 and 2019. Then we began to beef up our staff. And at this moment, Pascal, we haven't had anything we invested in since 2020 have a problem that we know of. I mean, of course, they're not done yet. They could have problems. They probably will. But at any rate, our earliest investments were probably our most mediocre for sure.
I mean, I think that's pretty normal whenever you start, right? Very rare to hit your best game winner on your first try.
Right.
Very helpful. Okay, I think that kind of sets the stage here for who we're talking to. Paul Moore here, in this for more than a decade now, and across a variety of different asset classes. Cool. So what I'd like to do now is, can you help us understand the capital stack? When people say capital stack, what does that mean? And I'd like to specifically go into and set up our discussion for today around common equity and preferred equity and the differences between them all. So kick us off. Give us a 30,000 foot view.
Okay, I'm picturing a stack with debt at the bottom. And of course, debt is in first lien position. It's the safest. I mean, it's got a lien on the asset, and it's also the most likely to have the least return. Of course, it could have the greatest return if things go south, but it's likely to have the least return. It's a capped return, and that's one end of the capital stack. At the other end of the capital stack, and most people think of it as a two-part stack, we did for years, is equity, or I would say common equity. Common equity has the highest risk. It's the first to take a hit if there's a loss. It could take a total loss. Debt could too, of course, but it's not likely. It could have a massive gains if there's 100% appreciation, and there often was, especially during the teens. The common equity would get all that appreciation, and the debt would, of course, get their money back with their interest rate that they agreed to. But in 2008, I like to ask, what would Warren do? What did Warren Buffett do in September 2008 when the whole world was collapsing, imploding? Nobody would touch, especially financial companies with a 39.5-foot pole. Well, he invested $5 billion in Goldman Sachs. Why? Why would he do such a thing? And then write a 1-page or 2-page Wall Street Journal article, taking out an ad, I think, to write why he did this and why we should invest in American equity. Well, he invested in preferred equity, not common equity. Preferred equity is in the middle of the capital stack. And if you want, we can also talk about mezzanine debt, which is in a similar position. But preferred equity is generally structured for immediate cash flow. And I'm not talking about Buffett's now. I'm talking about with a real estate deal. Immediate cash flow, but future upside as well. Often has a shorter hold time. It's got payment priority ahead of common equity, behind debt, of course. It's typically got lower downside risk exposure than common equity. It still receives depreciation benefits. Now, depreciation is a funny thing. The operator, the GP, can allocate it anywhere they want. And so they can allocate some to preferred equity where debt would never have any. There's a potential to negotiate control rights or forced sale rights if something goes wrong, bad boy carve-outs, ways to take over a deal. You may, as a preferred equity provider, you may be able to negotiate an equity multiple floor to potentially increase returns if taken out early. We're in a situation like that right now. We love that. Preferred equity is compelling in times when the lending market is dried up. Of course, about a year after the first rate hike in March of 22, about 9-10 months later, some regional banks that were making commercial real estate loans started to, well, some collapsed, others started pulling back, and it became a great time. It became very difficult, I should say, for existing operators to access equity that they had gained in projects. So a lot of them really, they would love to refinance, but they had a 3.3% interest rate that they got back in 2021. They don't want to refinance to a higher rate, but they would love to access their equity. One way to do that is through preferred equity. There were others making acquisitions and they couldn't get enough debt. Their LTV from the bank would be, let's say 50%, and they raised, let's say 30% from equity investors. Well, that left a 20% gap in the middle of the capital stack. So it was great for acquisitions. Development deals. There were development deals going on, especially in multifamily, and some of them needed preferred equity. And of course, there were rescue capital deals. And, for deals that were hurting, they were in trouble. They couldn't meet their loan payments, that floating rate debt had gone through the roof. Rent increases hadn't materialized. Costs, especially insurance, had gone up. And a lot of them needed rescue capital. And they did that. Instead of going back to LP investors, they might get pref equity and insert it into the middle of the capital stack, which some people would argue is not great for LP investors, but honestly, if it saved the deal, it sure could be. So that's what was going on. We always knew that the boom in pref equity, which we found from basically the beginning of 2023 till the end of 2024, of the type of pref equity I'm talking about, at least, we knew it would have a limited runway because eventually we knew lenders would come back into the space. Interest rates would drop. Of course, that hasn't materialized yet and might not right now. We can talk about that later. But we were getting coupon rates of 16 to 18% routinely. And that would look like 9% current pay plus about 7.5%, 8% compounding upside that we would actually get compounded and then would actually be paid off to us at closing or when they took us out at a liquidity event. So we were getting 17, 18% for lower risk. That was a pretty good deal compared to debt or a common equity in our minds. And so I'll just take a breath. That's how we jumped into preferred equity.
Yeah. Okay. So a couple of tidbits I'm pulling out here, right? So capital stack, debt first position, has the highest likelihood of getting paid off, capped returns, and then you have common equity, and preferred equity really only shows up. People aren't, raising preferred equity in normal circumstances is what I'm pulling here. It's a unique opportunity in a, given certain scenarios where these types of deals come up. Is that accurate?
Yeah. I mean, there are other times people would, there's an operator in New Jersey that had tax abated multifamily, and they are printing money from the way they do their projects. And for them to access and pay us 17, even 18% on pref equity, that was a no-brainer for them because they could use that money to go out and make 30% returns just for the GPs alone with that money. But in general, yes, these are times like I said, Buffett made billions of profit investing in preferred equity. Of course, that was different. It was in Goldman Sachs, but it was the same for us. We saw this opportunity as a narrow window. We did as many deals as we could, knowing that window would shut at some point.
So I know that preferred equity in I come from the venture capital world, and their preferred equity is incredibly common. It sounds like here in this scenario, you would almost always. Are there any scenarios where preferred equity is not ideal or better than being a common equity holder?
Oh, absolutely. Yeah. If the deal if it goes, by the way, the preferred equity, if you think about it, if there was going to be 50% common equity, and now let's say preferred takes 25, the 25 remaining preferred equity is now sort of in a position where it could have a much higher return, because the return will be spread across a whole lot less invested dollars. But if it goes really well and there's a very high return on the property, the preferred equity people, although they'll get everything they expected to get, the common equity people could make much more profit. So let me think of it. Here's a perfect example. We invested. Now, this was one of our very best deals, if not the best. So maybe I should tell you about a bad deal after this, just to be fair.
Yeah, let's do it.
We invested on February 25th, 2020. You might remember COVID was hitting the headlines that week. The stock market just dropped like a rock that week. We invested in a $7.1 million mobile home park in Louisville. It was $3.5 million or so in debt, $3.5 million or so in equity. And it was acquired from somebody who hadn't visited the park, lived states away. They hadn't visited the park in 5 years. It's a major institutional park, though, that was inherited. And we put in $7.1 million, got an offer of $9.5 million a week later, less than a week later. And I begged my operating partner, because we're not the operator, we're just the large investor. We're the largest investor. I said, why don't you sell it? Who knows? This COVID thing could kill us all, And he's like, nope, this place is going to be worth $13 million in 3 years. You watch. Now, that would have been a huge win. So he held on. It's not what happened, though. He actually got an offer and sold it for $15 million in 10 months. Right in the middle of COVID. He sold it to a long-term, larger holder of mobile home parks. And so we got a 347% IRR at the project level on that equity. Well, that would have been a terrible deal to be in pref equity on. I mean, it would have been nice to have, pref equity would have been fine. We would have got what we planned to get, but I'd have hated to have gotten 17% annual return when we got a deal like that. That would be a terrible time to be in pref equity, at least relative to the common. Now, we also that same month sold another asset that had been purchased a year before. It was a very small self-storage asset. We were the largest investor in St. Paul, Minnesota. You might remember the George Floyd tragedy that happened in St. Paul, Minnesota that summer. This was near there. It was hard to get police protection down there. It was rough for clients getting in and out. Even harder for employees who lived there. We just decided to sell it, or our operating partner decided to sell it for a 10% loss to a local operator. Well, if we'd have been in pref equity, that would have been a great place to be, because we would have still gotten our, let's call it 17% annual return, even though the common equity people lost 10% of their money. Does that make sense?
Yeah. So what I'm understanding is, common is taking the most risk but has the most upside, whereas preferred gets paid earlier or first out of the equities, but has a cap.
Yes, that's exactly right.
Okay. Very helpful. And there was one more piece that we mentioned here that I just want to make sure we touch on, which was mezzanine debt. Can you share with us how mezzanine debt fits into this picture?
Yeah, so mezzanine debt is kind of similar to preferred equity. It's usually a second loan. Like if you have a home equity loan on your home, you might have a fixed mortgage in first position and a higher interest rate second position equity line. Mezz debt's a little similar in the fact that it's in second position. It gets paid after the debt. They still can foreclose because they have a lien. They get no depreciation. And the returns on mezzanine debt might be similar, maybe a little lower, since there's a little less risk than the standard preferred equity that I'm talking about. By the way, we should eventually jump into another discussion about a different type of pref equity. We haven't started yet. I don't want to leave here until we talk about that.
Yeah, I think so. But I would love to maybe take us there, because the next part is I want to focus on how how Welling's kind of shifted there. So let's dig into that last part of equity.
Yeah, so we had this opinion that it was pretty. I mean, it was pretty obvious that there was going to be a limited window. Now, why? First of all, interest rates would eventually drop, and or banks would resume normal lending at higher leverage and relaxed terms. You could argue that some of that's happening right now, at least the lender part. When interest rates drop, sponsors who need to refinance wouldn't need this so-called gap funding like they did a year ago. When market uncertainty recedes, institutional investment activity would increase and common equity raises would be much higher. So that gap likely wouldn't be there. You've got higher lending, higher common equity, very small gap. So we assumed all that would eventually happen. So we made a plan that when we started getting to a place where we were getting no term sheets accepted at the 17%, our first plan was to drop to 16. When that didn't work, 15, 15 and a half, and then we would shift gears. And we already shifted gears. The other type of preferred equity would be, well, let me just give you an example. We recently invested in Odessa, Texas, in a multifamily deal with a great operator. The sponsor got the deal for $51 million, even though it was appraised in the mid 60s. There's a lot of things I could say about the property, but that's not important. There was $30 million in Fannie Mae debt. By the way, pref equity has to close behind Fannie or Freddie. They have to be approved by Fannie or Freddie. We have to be underwritten. And it's a lot of sponsors can't do it. And so now that we've developed a reputation for closing behind Fannie and Freddie, that's been really, really helpful for us getting deals. But anyway, they had 21 million in equity they had to raise. They had raised 6 million from the GP, friends and family, and they had a $15 million gap. We came in with 15 million, but here's how we did it differently. We said, we don't need an 8 or 9% current pay. We don't need a compounding upside to be paid in the future. They call it a PIK, payment in kind. We would just like to be pari passu with the other common investors, common equity investors. In other words, if they're getting 6%, we'll get 6. If they get 11, we get 11. And at the same time, we'd also like to get the same or approximately the same waterfall as the common equity holders. So how was it pref? It was preferred in the sense that we were still in the middle of the capital stack at the time of a liquidity event, meaning that if that 51 million value dropped to a $45 million value, if it dropped by 6 million at sale, that 6 million in GP and family and friends money would take all that hit and our principal wouldn't be touched in theory at closing. But we would also get for sale rights, bad boy carve outs, management controls, stuff like that, like other pref equity holders. And that's what we did with this deal. And it was a much lower burden on the operator. As long as this operator is confident that, hey, this thing's appraised already in the mid 60s. We don't think it's going to go below 51, even if everything goes south. I mean, obviously, if everything went south, it could, but they had a real high likelihood of, feeling like they weren't going to get touched. They felt very comfortable with that, and it didn't place the 17% burden on them that the other pref equity deals we would have done a year before had placed on them. So we call this JV equity, JV hybrid equity, and that's what we are moving toward now. And what it allows too is it allows us to access sponsors, Pascal, that are much more experienced, potentially higher quality sponsors, and a whole wider array of deals.
Why would
think about it too? It allows us to capture the upside if things go well.
I mean, totally. I mean, you kind of get the best of both worlds from the way that you're describing it. But what I'm confused about is, in this exact deal that you're talking about, right, where, it's a $60 million property that appraised to 51, why wouldn't that sponsor just raise all common equity if they're already buying at such a huge discount?
Yeah, they could have. They did not have the capital. They are a great operator. They do not have the capital raising chops to do it.
Interesting. And
some of our best operators don't raise capital real well.
Interesting. So it's more of like they raise as much as they can from their network, and then they need to maybe offer quote unquote better terms to maybe a new subset of investors to be able to attract the remaining capital they need.
Yeah. Good question.
Got it. Okay. So you mentioned something in there that I kind of wanted to dig into, which was you mentioned that the loan provider, Fannie and Freddie Mac, needed to underwrite you as a preferred equity holder. Yeah. Can you explain why and like what that means? I'm imagining they usually need to underwrite the operators. Mm-hmm. I don't think I've ever heard of a debt, a loan provider underwriting the investors of the common equity holders. Why would that be different for preferred?
So Pascal, I don't want to BS you. I don't really know all the reasons, but my understanding at a high level is that since we have management control rights, we have these carve outs. So if something goes south, we could take over, we could force a sale. They want to make sure that, we are not somebody who is going to mess up their debt.
Right. You, in essence, you are part of the operating team,
right?
With management control.
Yeah.
Makes sense. Okay. So all that makes sense. Okay. So right now I have an incredible 30,000 foot view. We understand, there's debt, which is in first position. There's equity, which is in second position. And then that can be broken up. Just for everyone that's listening, a good reminder, we have our common equity, which has the most risk and the most potential return. And then you have preferred equity, which sits in front of common equity, gets paid first out of them, but has a capped upside. So I would love to kind of take that and now dive into your specific strategy, how you approach it, and maybe what you're looking for. So are there certain types of asset classes where this works better than others? How do you think about that?
Yeah. When we launched into this, we were hoping to keep our balance of these 6 asset classes, 6 asset types technically, that we like to invest in, which again, are mobile home parks, RV parks, self-storage, multifamily, commercial retail, and light industrial. We hardly got any deals shown to us, Pascal, that weren't multifamily. I mean, we evaluated like 2 or 3, seriously evaluated 2 or 3 self-storage deals that didn't come to fruition, a handful of mobile home parks that didn't come to fruition, none in the other asset types, and then just a whole bunch of multifamily. I can't explain that other than to say, maybe it's just the quantity of deals being done out there. Maybe it's the fact that the debt and equity brokers we happen to meet over the last 2.5 years have all been focused on multifamily. For whatever the reason, every deal we have done so far in pref equity has been multifamily, which has really skewed our asset type within our holdings for our most recent fund. It's about a $75 million fund. And that's one of the reasons we did sidecars. In other words, we'd raise money on the side to help fund these deals, not put it all within the fund. But it also meant that the fund was theoretically safer because it is in a safer position in the capital stack, even though it's multifamily, which doesn't always have as much upside as heavy value add self-storage and mobile home parks, to be super honest.
Interesting. When it comes to these preferred equity deals, when a preferred equity deal is happening in a scenario where it's maybe considered rescue capital, it may be a good deal for the preferred equity holders. But in those instances, does it mean that those common equity holders are likely getting wiped out? Like, what's the likelihood when preferred equity comes into a deal that when the deal is at risk of falling apart, how does that quote unquote protect or help the common equity holders?
Yeah, let's look at a couple different scenarios. So let's say the deal is about to go south and the common equity holders are about to lose everything. The sponsor needs $3 million in the next 12 months just to make their interest payments, keep doing their value add, keep the lights on. And let's say that the preferred equity folks, whoever they are, come in and inject that $3 million in the middle of the capital stack. Then let's say the value adds work. Let's say that the huge structural housing shortage we have right now, by the way, kicks in. And let's say, that tariffs don't too terribly wreck the economy right now and all that. And the deal rights itself. And then in year 3 or 4, now it's sold for a profit. Well, the common equity people not only got their principal back, but hopefully they got a nice profit, or at least some profit as well. So, of course, Warren Buffett's first rule is don't lose money. Second rule, see the rule above. And I was talking to a sponsor 2 days ago, was talking about the devastating impact of losing 50% of your capital. Now, I'm talking to LP investors now individually, really. But he was saying, look, you can make 50% and yay for you. That's great. We all want to make 50%. But he said, if you lose 50%, it's much worse than it is positive to make 50. And the reason is you need to make 100% return just to get back to day one. And so what you do as an investor, if you're a normal person, you start saying, well, I've got to hurry up. I got to make this 100% return just to get back to where I was a year ago. And so you start making quick decisions. You start using FOMO. You start taking riskier bets, and you might end up losing that 50% as well. And so it is really devastating to lose money. And so for those common equity investors who survived and even just got their principal back, it's a lot better, obviously, than if they would have let it run its course without the preferred equity. So that's one scenario. Make sense?
Yeah, totally.
Another scenario is the preferred equity people come in, save the deal, but now there's $3 million in front of that, let's call it $10 million in common equity. And now they sell the deal for a loss. And let's say it's a $5 million loss. Well, now, because that $3 million got inserted in there, the common equity people might lose a lot more than they would have otherwise. And in fact, if it's sold at a big enough loss, it's possible that the debt and preferred equity people could get paid off, and who knows, the common equity people could make nothing. So it could really wipe them out, but it's likely they would have been wiped out anyway in most of those situations, right?
Yeah, absolutely. So are there specific things that an LP needs to think about when they're looking at preferred equity deals? Like, what are the nuances here, right? I mean, if I'm an LP listening, I'm an LP here interviewing you, and I'm thinking through to myself, okay, light bulb turned on. Preferred equity sounds very intriguing. I don't need to get a huge home run. I'm okay with my upside getting capped, but I do like kind of being in a higher priority position. Where can I go wrong? I start looking at the deals you have. I might start looking at the deals that we find from other operators. And what are maybe some of the gotchas or the nuances?
Well, I would say that, again, you're going to want to invest with somebody who knows what they're doing. You've got to really, the number one risk for all of us, at least I think, Pascal, is fraud. And most of the people who commit fraud didn't wake up in the morning and say, hey, I think I'd like to go to jail for 75 years. and commit fraud, they usually make one mistake or have one problem that they cover up with and say, well, I'll just dig my way out of this next month. And then it's another problem. And of course, we know the old saying, what a tangled web we weave, when first we practice to deceive. And so I think your number one issue is fraud with any investment. And so I think that you really, really want to be super careful and ask yourself, do I want to be in a difficult deal with this person, this operator, for the next decade? Because even if it's a 5-year deal, and even if you know it's going to go well, it might not. And it might turn into a 10-year deal, and it might turn into a lot of stress. So ask yourself, do you really know, like, and trust this person? Fly out there. See him. If you're going to wire them $100,000, my goodness, take a $800 flight and go see them in person. Ask your gut. What are you feeling? Is it just your head saying this is a great deal, or is your gut aligning with that? Ask your wife if you're a guy, or less helpful, ask your husband if you're a lady. We can talk more about that if you want. But seriously, I really believe we were created with like 2,000 sensors to sense if somebody's lying to you. And I don't think our cognitive brains know what those sensors are, but I think our gut or our subconscious was wired and designed to pick up those signals. Not always. And like I said, they don't always have fraud on their mind up front. Some people started off well. Almost all of your listeners know about the big ATM deal that turned into a fraud. That didn't start out as a fraud. That's something that descended into fraud from what I've heard from everybody that was close to that deal. And there's a lot of other ones like it. But, ask your gut, check your gut, check the debt. What kind of debt's being used? What's the quality of the underlying asset? What's their assumptions? Do they really believe that rents will continue to go up 11% a year, like I said, in Tucson every year forever? Probably not a good idea. Do they really believe they're going to get 98% economic occupancy? Probably not true. So check the underlying asset. Again, this is a lot of work, but do some stress testing. Really check and see, what happens if things go south in any of these dozens of areas. Get Brian Burke's book, The Hands-Off Investor. Read it carefully and go evaluate using those terms. And if you can get through the book, and if you can get through that type of analysis, you're a better LP investor than most. But these are the type of things to look at, and they're not all easy to uncover. We actually do a net operating income audit. We get a third party in and spend about $10,000 that doesn't come out of the investor's pocket to evaluate the deals we're about to invest in. That's a lot of work.
Definitely. Is there a range in which we should look at preferred equity deals? Like, it's not really interesting or a preferred equity deal if it doesn't generate at least 10% or 15%, or hey, if they're offering more than 30, if they're saying it's a 30%, is that realistic? Like, what are the realistic scenarios, the inner and outer bounds?
Well, we feel like at the operator level, us being the operator in this case at the fund level, we think, a 12, really 13 to 18% return for typical preferred equity is a good range. A lot more than that, I would really guess it's likely a high risk deal. Now, some development deals might be in the low 20s, and they may not be. If it's a sponsor that's been doing this for decades successfully, it may not be that bad. But I'd have to ask, if that's true, why are they paying 22% to get this preferred equity? I do have a scenario where that was true. I have a friend at church. He walked up to me. He's like 73 years old. He's like, I got to talk to you now. I said, what's wrong? And it turned out he'd been doing development deals in Myrtle Beach for decades. His bank, who he thought he was his friend for like 22 years, his bank left him hanging at the closing table on a huge piece of land. He's like, I don't care if I have to pay 25% to a private lender. I need to get this deal closed, because he had a potential massive, massive profit. And he knew what he was doing. Well, okay, that's maybe an exception to what I'm saying, but I would generally think the returns would be in the teens. Now, if it's a JV hybrid equity I mentioned before, your returns could be all over the board, just like other, common equity holders.
Is there too much preferred equity that you can have in your portfolio? In terms of portfolio construction or the amount of the types of deals that you invest into, can you have too much? How does that fit into a greater portfolio strategy?
I wouldn't think so. When I started talking to really wealthy people like 15 years ago to invest in our deals in North Dakota, I was really surprised when they would say, mid-teens returns? No, thank you. You want more? No, we want less. What's that now? And the super wealthy, a lot of times, especially the mature ones, they're like, look, I'm just looking to get a 7 or 8% return. I just want to stay ahead of inflation. I just don't want to lose money. And I know that when there's a 1 or even, heaven forbid, a 2 in front of the projected annual returns, I'm way more likely to lose money. And I don't want to do that. I'd rather just get a safe 7 or 8, 9% return. And with that kind of thinking, I haven't thought this through before. No one's ever asked me what you did, Pascal, but I would think that any amount of pref equity would be fine.
Are there, I like to think that investors should figure out what situation they're in and then what investments make sense based on their situation. So an example would be like, if you're trying to write off W-2 active income, there are only certain asset classes like oil and gas or certain loopholes, like the short-term rental loophole that you can use in order to achieve that goal. Is there a specific type of investor who is best or better suited for preferred equity versus common?
Yeah, well, if we want to call the original type of pref equity that we did, that I spent most of the show describing, I would say that's somebody who might want income. Like, look, it's a development deal, might go 3 years with no income and then get 150% return in one day at the sale. Other deals might, intense value add deals might have very little income and then high return later. Pref equity, the way I described it before, like I said, could provide a 9% income, at least at the fund level for us. And that could present maybe an 8% return to the investor. Well, I think that would be a good fit for preferred equity, somebody who wanted yield, a little bit more safety, a little less drama, and they were willing to forego the potential wild upside if it goes really well.
Helpful. Okay, cool. That was very helpful to kind of dig in here. I would love for you to have an opportunity right now just to kind of share with investors who are interested in this kind of strategy. What are current funds that you have right now that align with this strategy?
Yeah, so we have had our company's Wellings Capital. We've had the Wellings Real Estate Income Fund open for years. But by the time this goes live, I would think that we will have 2 new funds, a Wellings Evergreen Income Fund and a Wellings Growth Fund. Now, we've had a little problem. And like I said, we looked at 745 deals and did 5 last year. A lot of the deals we passed on were fantastic deals at the ends of the barbell. Here's what I mean. We were a growth and income fund, and the last 5 funds have been. Well, if we would get a deal that was really nice, strong 11% income, but had no growth component, we might pass because we're trying to get, let's say, 14% total annual return or total IRR. We might get another deal that there's a developer, that's developing apartments, and he's got a cookie cutter approach where he, for decades, has been generating a 33% IRR, but there was no income at all. It was just what I mentioned earlier, just years of waiting. And then in year 3.5, he sells for a huge profit. Well, that wouldn't fit either because there was no income in that growth deal. So we've actually developed an income fund, which is evergreen, and a growth fund. which is closed end. And like I said, we plan to offer those shortly. And we expect that at least 60, if not more like 80% of the deals in there will be either preferred equity or more likely the JV hybrid equity that allows us to be in the middle of the capital stack with some forced sale rights, but still capture all of the upside of the other equity holders.
Awesome. I'm going to take a look at that. This has been incredibly helpful, insightful. I've learned a lot. And thank you to the audience, everyone who's been kind of chiming in here on the live show. As a reminder, if you enjoy following on these live, you can participate in these through the Best Ever community. But Paul, where can people go learn more about you and Wellings Capital?
Yeah, they can go to wellingscapital.com. That's WELLINGSCAPA. You know how to spell that. Better than I do because I just messed it up. wellingscapital.com. And if you want some special reports we have on mobile home parks, self-storage, multifamily, RV parks, etc., or even an introduction to commercial real estate investing as a passive LP, you can go to wellingscapital.com/resources. And I wonder if I can actually add another comment, Pascal.
Yeah, let's do it.
We are celebrating, I don't know what year it is anymore, I should know, but about 160 years since slavery was outlawed in the U.S. and about 200 years since it was outlawed in Great Britain and a lot of the Western Hemisphere. Yet, there are almost 50 million enslaved people in the world. Since we started this podcast, hundreds and hundreds and hundreds of children have been sold into slavery or abducted. And if you took the record profits, not the average, the record profits of ExxonMobil, General Motors, and Nike, added those record profits together and tripled that number, that's the approximate profitability of human trafficking every year. And so Wellings Capital is really trying to raise awareness on this, and we're trying to raise money to help fight this great evil and rescue these kids. We've helped influence $840,000 that we're aware of in the last 3.5 years. And we would really love for people to get behind that, find somebody you trust, watch Sound of Freedom, watch the old 2012 Nefarious movie to learn more about this. Or you could even go, if it's okay, I'll share, to aimfree.org to learn more about how AIM is doing this really great job of this in Cambodia and Belize.
Love that. Thank you so much for joining us today, Paul. And for those who are listening, just another tidbit here. If you want access to more cash flowing real estate deals like those from Paul, you can grab my Passive Investing Starter Kit at passiveinvestingstarterkit.com. It's one of the best ways to kind of see a lot of these 506c opportunities land in your inbox every Friday. And here on the Passive Income Playbook, part of the Best Ever CRE show, we drop new episodes every Thursday. So be sure to tune in each week for more real conversation strategies and stories to help you grow as a passive investor. If you enjoyed today's episode, as always, please subscribe and leave us a 5-star review. It helps us reach more investors like you. And thank you for tuning in. And I will see you next week for another episode of the Passive Income Playbook.